Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I am so glad that you joined us on all major podcast platforms and also on the Fun with Annuities YouTube channel, where you can see the dashingly good looks of me and my celebrity guest that's joined us today. I'm so happy that he's doing that. I'm a big fan of his newsletter, and I'll give you all of that information where you can sign up. His name is Allan Roth. Let me tell you a little bit about him. He is both a financial planner and a writer. He writes investment columns for publications such as, and you've read him in ARP, Barron's, ETF.com, Advisor Perspectives. The list keeps going. And he's been an adjunct finance professor and faculty member at Colorado College, University of Colorado at Colorado Springs, and the University of Denver. He's quoted in everything you're reading, whether it's Wall Street Journal, New York Times. He's been there. He's been on TV. He's the founder of a firm called Wealth Logic LLC, which is a full financial planning firm based in Colorado Springs, Colorado. I would encourage you to go there. Like with all of my guests, I'm going to have a page on my site that has all their links, etc. He's been doing this a while, and I think his approach is very, very good. He's a licensed CPA. He's also a certified financial planner. He got his MBA from Northwestern University. And he claims, like I claim, to keep investing simple, like I keep annuities simple, and his goal is to never be confused with Jim Cramer. With that being said, welcome to the show, Allan Roth. Thank you so much for being with us.
Oh, thank you, Stan. That was a very nice introduction. I appreciate it.
You've earned it, deserved it, and I didn't even go into a tenth of what you've done, which is a lot. What I wanted to jump in is just kind of your approach. How do you approach financial planning? Kind of give us the oversight of that. And I think maybe you could start. I think you have investing in 8 words. I read something where you wrote an article about that. Can you talk about those 8 words and then drill down on those 8 words as well?
Sure, my pleasure. In 8 words, investing is minimizing expenses and emotions, maximizing diversification and discipline. So let me explain what I mean by that.
Okay.
Minimizing expenses, the example that I give is when people come back from Las Vegas, I ask them if they won money, and roughly 2 in 3 say they did. But we all know they're not building those billion-dollar casinos to give money away. Same thing comes to investing. Everyone says they beat the market, but we don't live in Lake Wobegon where everyone is above average. We live in the real world. So if the market earns 10% and we pay 2% in the way of fees to an advisor, to the funds that they pick, or a combination of all of them, then on average, they're going to get an 8% return. So minimizing expenses, you can have funds as low as 0.03%, even lower than that. You're going to get the market return. Next is minimizing the emotions.
That's a tough one. That's a tough one, Allan.
It is a very tough one. I know a lot of people that have very low cost, wonderful portfolios, but they still panicked and sold in 2020. Because in 2020, in 33 days between February 19th and March 23rd, the stock market lost 35% in only 33 days. And you've got to have the emotional fortitude to stay the course and not panic and sell. And emotions cause us to way underperform what funds do. Mm-hmm. And we typically chase performance. Kathy Wood's ARKK, ARK Innovation Fund, has been in the news a lot, and it had stellar performance. And then money poured in just in time to see it do horribly. So even though the fund is way up since inception, the average investor has lost money. So those are the minimizing the two E's. Next is maximizing the two D's. And diversification is the first. And I have people that come to me and they have pages and pages and pages in their financial statements, and they're incredibly undiversified. What works a whole lot better is I have a total stock index fund that owns as close as possible to every company based in the United States, and a total international that owns as close to possible to every other company based outside the United States. So with those two funds, I'm diversified in stocks. I own over 10,000 companies across the planet. And then the discipline to develop a plan and stick to it. Not only did I not have to panic in March of 2020, but I had to follow my discipline that said I'm going to be at a certain asset allocation. And if I'm outside that range, I've got to rebalance. So I had to buy stocks in March of 2020 when they were on sale. And that's easy to explain to any 8-year-old why you're buying when it's on sale, but it's very hard for a human. It was very hard for me to buy more stocks then. So again, investing is minimizing expenses and emotions, maximizing diversification and discipline.
And the two hardest ones on that, in my opinion, and I want to hear your opinion, are emotions and discipline. Am I right about that?
I think you're right, but they also, the emotions lead us to buy, the expensive funds and, the undiversified. So they're all related. But yeah, the emotions are everything that really led us to survive as a species. Our instincts, our human emotions fails us when it comes to investing. In fact, a sign you're doing something right is that it hurts. A sign you're doing something wrong, it would have felt wonderful to get out of stocks on March 23rd of 2020, and it would have been the wrong thing to do. And I felt like puking as I was buying more stocks.
Right.
Back then.
Right. That's the correlation of working out versus sitting on the couch, right?
Yeah.
It is what it is. Hey, before we're gonna dive in. I want the listeners and viewers just to hang in there. But Allan, I want you to explain Wealth Logic and your approach to financial planning, which is very, very unique. I do encourage people to go to his site, which is, you're going to love this, daretobedull.com, just like it sounds. I'll have that on the site. But can you explain to the people saying, hey, I kind of like what Allan's talking about, I might want to interview him. Tell him how that process works.
Yeah. Well, first of all, I want to brag. It's not easy to be as dull as I am. I dare to do it. But yeah, the way I work is I do a one-time plan. I'm not cheap at $450 an hour, and even a simple plan takes at least 10 hours or so. But it's a one-time plan. I don't make any money off of one recommendation over the other. Rules going forward. And then I'm sorry to brag on your podcast, but I've got the worst retention record of any advisor out there. I do a one-time plan with the goal of being fired.
I love that because it's so purely objective and transparent. I've never heard of anything like that. Maybe there's other people, like not at your level, of course, but I just think that is fascinating. What led you to go in that direction? What was the fork in the road moment for that decision to run a financial planning firm on a national basis like that?
Well, every profession on earth, for the most part anyways, is fee for service.
Right.
And if I go to a doctor and the doctor cures me, I'm going to stop paying them. So it's a combination of that. And plus, I don't know what the market's going to do next year. If you ask me that next year, I won't know what the market's going to do the year after. So it's a combination of rules. And the financial planning part is complex. Once you get to the simpler financial plan, running it is fairly easy. It should take somebody, 1 or 2 hours a year once we've developed the plan.
Well, and I laugh because I know that a lot of the firms, I used to work for all the major firms, they had the cookie cutter, punch in the number plan, and then you got the binder and you go, here's your plan. That's not what we're talking about. Okay. Allan does a deep dive in, which is why he charges what he charges. But I always tell people, you get what you pay for. You really do. So we were talking the other day, and you were saying that 2020 and 2021 were really hard years for people writing about finances. Because, as you said very, very appropriately, markets exist to make fools of us all. Can you expound on just the 2020 and 2021? And I'm assuming we're going to see that same type of writing in 2022.
Well, if I only knew what the markets were going to do for 2022, then I'd have beaten Jeff Bezos into space. So.
That's right. That's right.
But yeah, and if we look at the combination of the full year 2021 and 2022, the total stock market, meaning the Vanguard Total Stock Market Index Fund, gained over 52%. Now look at what happened. No one had heard of coronavirus. I hadn't even heard of Zoom video, by the way, at that point. We have had, massive unemployment, incredible deficit spending, issuing so much debt. The political divide and unrest is high, much higher than I've ever seen it. We've had social unrest. It's just been 2 horrible years, and COVID just won't seem to go away. I'm a pessimist by nature, but I was way too optimistic on this coronavirus. So, I admit, if I had a partial crystal ball and knew all this was going to happen, I might have gotten out of the stock market, and that would have been the incredibly wrong thing to do. As mentioned, stocks went up over 52% in spite of all of that bad news. It would have been a whole lot easier for headline writers to explain why markets dropped by 52% than went up by 52%. So markets really do make fools of us all, and that's why rules work so much better. I had to rebalance because my rule said I was out of tolerance and had to buy more stocks.
Yeah, and that's why you keep coming back to the core foundation of what you do, which is minimizing expenses and emotions, and then maximizing diversification and discipline. I think that's the foundational floor of your planning and making sure people understand that. No one knows. We're not predictors here, but we're commentators, and we have a lot of decades and decades of experience. Inflation's a tough one right now, and interest rates allegedly are going to be raised. Anytime the Fed says, "Hey, we're going to raise rates X amount of times," I look at them, because I've been around like you, going, let's see it. Let's see what happens. That half crystal ball that you sometimes have, what are you thinking right here? Not that it's a pound the table prediction, but what's your gut feel tell you?
My gut feel is almost always wrong, which is why I ignore my gut feel. But first of all, the Federal Reserve controls only one rate, and it's called the Fed funds rate. It's the shortest of the short term. It's an overnight rate. Mm-hmm. Markets control intermediate and long-term rates. The Fed doesn't. They tried to influence it by buying back its own debt, otherwise known as quantitative easing. Mm-hmm. And let me explain. In 2008, we did a lot of quantitative easing, and then the government announced that QE1, QE2, QE infinity, they were finally going to end it, and all the economists said bond bubble, bond bubble. Because when the Fed tries to buy back its own bonds, they're trying to keep interest rates low. So when they stop, people are going to want a higher return. And I wrote a piece saying, on bond bubble, don't be so sure. Markets aren't stupid. Markets knew that the government can't be buying back its debt forever. And lo and behold, interest rates actually dropped. So the intermediate and long-term bond market, that's controlled. If we all knew that interest rates were going to go up when the Fed has its Treasury auction this week, we would bid less money to get a higher return, and rates already would have gone up. And the top economists have called the direction of the 10-year Treasury bond right, meaning up or down, 30% of the time over the last 50 years, less than a coin flip. And by the way, that study was incredibly disappointing to me, because before then, I thought I was uniquely qualified to forecast interest rates wrong. I just knew that I didn't have the ability to forecast interest rates and didn't move on it. But that was really disappointing, because it turns out I'm up there with the top 50
That's
economists.
a crazy stat. 30% of they're batting 300. I guess if you're a baseball player, that's okay. But if we're talking about money, that's not okay.
Well, a coin flip is 50%.
Yeah. It's
And
the monkey throwing the dart, right? It's that whole scenario. And these are, I guess, the smart people in the room. That's when I heard Janet Yellen say, well, this inflation might be transitory. I'm like, you have absolutely no clue what you're talking about. You might think you do, but I mean, it doesn't look looks like this inflation transitory means it's going to be around a while in English and Southern. It looks like it's going to be here for a while, don't you think?
Well, argumentative Val is going to have a different perspective on that. Yeah, the way I learned economics in college, when there's more money chasing the same amount of goods and services, that's going to cause inflation. But Japan has been printing money far faster than the US, and over the last 30 years has been fighting deflation.
Mm-hmm.
And yeah, I remember back in 1981 when interest rates were at 12%. And by the way, I can explain why those were horrible times. Because we had high inflation, we had a stagflation sort of economic environment at
Mm-hmm.
the time. But you know, if markets believed that we were going back into that area, then interest rates would have gone way up. I know you're reading the headlines, interest rates surge, but those headlines are incredibly misleading. If you take a look at over the last 40, 50 years, it's a little blip. And we've had blips larger than this. And quite frankly, you know, I don't know whether we're going to have higher inflation, whether we're going to go back into double-digit inflation, or it really is going to be transitory. And in a year and a half, we're back down to the 2% federal target. Anything can happen.
Here's a hard pivot, Alan. Should people reframe their Social Security decision?
Yeah, I think so. You know, our natural instinct is we've been paying into Social Security for so long that when we have the ability to start collecting, we want to get it. But what I do is I explain to people what they're giving up over, let's say, between ages of 66 and 70, and what they are getting in the way of a higher payment. And it is the single best inflation protected U.S. government backed annuity on the planet.
You got it.
You
Exactly
can't buy
right.
this anymore, but insurance companies used to offer a single premium immediate annuity or a deferred immediate annuity that had a COLA, that had a inflation COLA.
It had a they do still do it, but they had also the CPI increase, which is no longer. You can't buy an annuity with the CPI-U, consumer price index for urban consumer index increase. And also too, just to interject here, annuity companies don't give that away. Okay, they just lower the price or make you pay more money for that. Whereas the government, that's a political football. That's the best inflation annuity on the planet. So go ahead.
Yeah, you're right. You can't buy that anymore.
Nope.
With the CPI-U, which hedges against inflation. Why?
Sure.
Because the actuaries don't want to take that risk. I don't blame them. So yeah, when you're delaying Social Security, you're getting the best inflation adjusted annuity on the planet. And back when you could get it, by the way, I would do the calculation and show it to the client that they could buy this inflation adjusted annuity or delay Social Security, which is like buying the same thing with a 40% discount.
Exactly. No, exactly. You're exactly right. I think the last carrier was 3-4 years ago that was finally pulled the CPI-U in COLA option that you could attach at the time of application. So those are gone. I know that when you do financial planning, you know, everyone is different. It's a customized plan for every single person, and retirement is a broad-based word that needs to be drilled down for the specific person that you're speaking with. But in your opinion, and with your background, what would you consider a safe spin rate for someone looking at retirement, or maybe describe what that is so that they understand it?
Well, when you're calculating a safe spin rate, you're looking at the value of your portfolio. And to that, by the way, I would add something like the value of your house. I would not put cars or furniture, things that are depreciating. And let's say, somebody has, just to make a number easy, $1 million between the value of their house and their portfolio. How much can they safely spend? And by the way, the reason I use the house is later on in life, they could always downsize, you rent, sell the home, take out a reverse mortgage. So they can tap that equity. So if somebody had $1 million, what percent of that can they spend each year? And they have to increase it with inflation, by the way, because if you don't increase it with inflation, you're cutting your lifestyle.
Mm-hmm.
And the answer to this question is it depends. And it depends on a few things. Number one, how old you are and what your life expectancy is. So somebody that's 50 years old is going to have a much lower safe spend rate than somebody that's 90 years old.
Sure.
And the next is how it's invested. And it turns out that if you have an incredibly conservative portfolio or if you have an incredibly aggressive portfolio, that cuts down on the safe spend rate. And then finally, fees matter. So for instance, 1% in fees cuts that safe spend rate down by about 0.4%. So for somebody, I've done a lot of modeling on this, and Morningstar came out with an incredibly good study on safe spend rates, looking at all of these factors, and just a nice chart on how you're invested, how many years you need the portfolio to last, of what that safe spend rate. And it turns out that a 50-50 portfolio of somebody that wants it to last for 30 years comes out to about 3.3%. So that means $33,000 on that $1 million, and then increasing each year with inflation. And that comes to a 90% probability that the money would last for the 30-year period. But again, that assumes you're minimizing expenses and emotions, maximizing diversification and discipline. Otherwise, it's going to be a lower safe spend rate. And then finally, I recommend developing a budget and developing that budget, put every line item in a discretionary or non-discretionary, meaning that if stocks tank and stay low. And just last year, the Japanese stock market got back to where it was in 1989. So we've had teddy bears so far this century that have recovered very quickly, and we don't know that the next one will. So be ready to cut if things aren't going so well. And by the way, to that, you can add Social Security, or by the way, if you're delaying Social Security, I would say you could go ahead and spend what you would have received had you taken Social Security today, because really what you're doing is buying that inflation adjusted deferred annuity.
Correct. And I just keep going back to your foundational statement of minimizing expenses and emotions and maximize diversification and discipline. Eerily similar to my PIL acronym, that's you buy an annuity for either principal protection, income for life, legacy, or long-term care. That's it. If you don't need to contractually solve for that, then don't buy an annuity. I like your simplicity of that thought of the minimizing expenses. It's interesting. People hear that, but I don't think they really run that number of how it eats away at what you have. In a brokerage and banking advisory world where those people are being forced to wrap these accounts with advisory fees. I just know that that does work in some situations, not all, just like everything else. But the diversification and discipline, that's where the plan comes in. Now, when going back to kind of the Wealth Logic and your company and your planning and your strategy and what you do, which is so unique and good, I'm assuming that when you're done, you're handing people a thick, legitimate, easy to understand, or is it thin, legitimate, and easy to understand folder?
Brilliant. It's the latter. It's the thin.
I thought so. I was hoping so, because I had someone actually send me their financial plan from someone, and literally, Allan, it was 2 inches thick. And I was like, that's too much. I don't know what they're selling you, but that's too much. So it's really, you stripped it down even from the retirement planning standpoint, right?
Yeah. When I started this about 20 years ago, I looked at so many different pieces of software
Right.
that produced the 2-inch thick. And all I can say is it was garbage. It was making incredibly horrible assumptions, underneath in the engine. And it was so precise on what every asset class was going to return, ignored fees, just made a whole bunch of, horrible assumptions.
Mm-hmm.
Monte Carlo simulations, you garbage in, garbage out. I'm a big believer in Monte Carlo simulations, but realistic assumptions in, you'll get realistic answers out.
Correct. It's like the back-tested numbers that people get in the annuity world that show 7%, 9% returns. I'm like, come on now, you got to have you can't be the sucker at the table. Annuities don't work like that. That's the reason you need people like Allan in the non-annuity world managing your money. And I'm assuming they can just go to daretobedull.com. There's places to sign up there. If you do one thing, listeners and viewers, sign up for his newsletter. You're talking about gold. That is good stuff. I've been reading that for 10 years, I bet you. Can people just sign up and get your newsletter, Allan?
Yeah, it's a sign up. It's a double opt-in sort of thing. So check your spam filter. It's free. There's a zero cost, but
unbelievable.
Your viewers, I'm willing to give a 20% discount to that.
To the free? That's phenomenal. That's phenomenal. So 20% off free. That's I love Allan, dry sense of humor. And also, just if you're listening to him talk, there's a lot of IQ behind there, and there's no agendas. He does this because he's good at what he does, which I just love his approach. I ask people like you, and sometimes they get mad, sometimes they don't. So I apologize up front if you say, "No, I don't want to talk about that."
I don't want to talk. Oh, okay.
Crypto.
Yeah. People are kind of shocked that I own some Bitcoin.
Really?
And the reason I own some Bitcoin is I wrote about it for AARP roughly 3 or 4 years ago.
Okay.
And in order to see, it was Bitcoin basics, how you go buying it, et cetera. I wanted to fact check it and see if it actually worked the way the experts said it worked. And so that's why I bought a little bit of Bitcoin. Well, when I say a little bit, I mean $200 worth.
There you go.
So, Bitcoin, there are pros and cons. I think that it does serve a need. For instance, if I buy something from Amazon or Walmart, I think the 2 largest US retailers, and use my credit card, I'm going to get 2% cash back. And that the credit card company is charging the largest retailers more than 2%.
Sure.
So with crypto, you can disintermediate the bank and buy things with Bitcoin, et cetera. Another benefit of Bitcoin is that it, there's a finite, I think it's 24 million coin out there to be mined. And some of it, by the way, has already been lost. People lost their codes to their wallets, et cetera. With that said, I wouldn't put more than 1% in Bitcoin. We don't know whether, there's well over 1,000 cryptocurrencies. Dogecoin started as a joke, has significant value. I'm thinking of starting Roth coin. Can I advertise it on your podcast?
Absolutely, Roth coin. But the problem is people would think it's called Roth IRAs. They'd mix it up and mess it up. I'm going to read something to you. Somebody sent to me the other day, which is a prediction that I made early on, which is a no-brainer if you think about it. The Biden administration is preparing an executive action to ask federal agencies to regulate digital assets such as Bitcoin and other cryptocurrencies as a national security matter, and create a regulatory framework to cover cryptos, stable coins, and non-fungible tokens. As a person familiar with the plan told one of your places, Barron's, this effort would involve the State Department, Treasury Department, National Economic Council, Council of Economic Advisors, the White House, National Security Council, and all those people to develop a more coherent government policy overseeing the digital assets. Here's my thought on that, Allan. I think they want in. I think they want U.S. coin or whatever they want to call it, and I think they want to tax us real time, because the underlying technology of crypto is blockchain technology, which is a legitimate technology. What's your comment on, forget Biden, it could have been anybody. I mean, the government itself stepping in and muddying up the works.
Well, you know what this is a list of?
Well, he's holding it for the podcast listeners, which is 95%. He held up a sheet of paper. For the other people watching on Fun with Annuities, it's hard to see. So just kind of tell us what you held up.
It was a blank sheet of paper. That's all the politicians that I endorse. So I'm not going to get into politics, but yeah, I suspect the government wants its share of taxation for transactions, for gains, etc. Just like they capture on everything else, and
no doubt.
Yeah, I suspect that's what's going on. And also, I think they want to try to clamp down on some illegal activity, such as what was the pipeline that was shut down and got the Bitcoin.
Yeah, there's some nefarious stuff, but still most of the fraud's done with hard dollars. I mean, that's a fact. So I think it's one more power grab. I know crypto is the wild, wild west, but it's interesting to get your take on it. Obviously, I'm sure people ask you about that all the time. One of the things that cracked me up is you listed somewhere, and I wrote it down. I'm probably surprised you with this, and you wrote that you charge a lot of money to clients to tell them that you don't know certain things, and you listed 5 certain things. I wrote them down if you don't have them in your head, but if you have them, give us 5 things that you don't know about.
Sure. Clients ask me, what do I think the stock market is going to do next year? And my answer is, I haven't a clue.
Number 2. What's number 2?
If we can't even explain why the market's gone up 52% in the last 2 years, what makes us think we can forecast the future?
I love it. What's the second one?
Will international outperform the U.S.? Finally, international has way underperformed the U.S. over the last dozen years or so. Mm-hmm. And lo and behold, this year, in the first few weeks, international is doing better or less bad than U.S. And now I'm getting people coming to me saying, should I have more international? And the answer is, based on a whole 4-week trend. You want to pick an asset allocation and stick to it, because I don't know whether international is going to outperform. What styles and sectors? Tech has been hot. Large cap growth has been hot. What's going to do better over the next year? I don't know, which is why my total stock index fund owns large companies, small companies, mid-sized companies, value, growth, core, every industry, every sector. Which stocks will outperform? Boy, if I knew which stocks would outperform, as I mentioned, I'd have bested Jeff Bezos into space and maybe even landed on Mars by now. And then what will happen to rates and bonds? I've known for a long time, I have no clue of what's going to happen to rates. I have all these instincts on all 5 of these, by the way.
Sure.
And I have to work very hard to ignore those instincts.
I want to stop for a second and have the listener and viewer just think for a second about what Allan just talked about. Here's it. How will stocks perform next year? Will international finally outperform the U.S.? What styles or sectors will outperform? Which stocks will outperform? What will happen to rates or bonds? Every single Yahoo advisor out there that you ask, they're going to have an answer to that. And if you ask Jim Cramer, who Allan will never be mistaken with, they're going to jump in and they have no clue. That's the refreshing part about what Allan does. And the reason I encourage you to go daretobedull.com, which is his site. Think about this. He is one of the best financial planners in the country. And he named his site, which I love, daretobedull.com. Once again, we'll have that on our site. But I just think it's refreshing, Allan, that you're not trying to be a master of the universe like most people.
Investing is boring. And look, if they gave me a TV show, my first episode would be those 8 words. My second episode would be episode 1. I wouldn't watch the show. It would be so boring. So, if you're looking at investing as entertainment, and by the way, I carve out a tiny little bit of money to have a little fun with. There's nothing wrong with that as long as your future isn't based on that. Because, it exercises a piece of my brain that index funds and disciplined, low cost, boring investing doesn't exercise.
I wanted to pivot one more time. All my pivots are good, Allan, but this is a really good one. Allan has written a book called How a Second Grader Beats Wall Street. I want you to think about that for a second. That is fantastic. And you can go to, you can go to his site and look at that. He actually has a secondary site for that book that we'll have up as well, called secondgraderportfolio.com. But tell us a little bit about that book. And before you start in, one of the things, and our team did the research, you know, you had 13 golden rules of a second grader to beat the market, which I thought were just hilariously good and factual. If you have enough time, let's go through those 13.
Yeah, well, it's not beat the market, but it's beat most investors.
Okay.
So when my son was 8 years old, I was teaching him lessons that we all teach our kids, that I'm realizing people violate when it comes to investing. And then Kevin, my son, when he was 8 years old, money didn't mean anything to him. So the emotions were out of the picture. Money at that time might have meant a candy bar or something like that. He's 24 now. Money is meaning more to him, so he's losing some of his advantage. And by the way, I'm asked why I haven't written another book, and I blew my wad with that book. When I wrote it, everyone was talking about, income portfolios, master limited partnerships, small cap value, things that all blew up.
Not Allan Roth. Not Allan Roth. Allan Roth wrote a book called How a Second Grader Beats Wall Street.
Yeah. So, the 13 golden rules are, number one, just arithmetic. We've already talked about it. 10 minus 2 equals 8. The more you pay in fees, the lower your returns are going to be. The next is don't put all your eggs in one basket. Apologize, I thought I had that on Do Not Disturb. Don't put all your eggs in one basket, but I see people violate that all the time. We're all in munis. We're all in a handful of stocks. If you drop that basket, you're going to lose everything.
Yep.
Number three.
Number three is my favorite one. So go slow.
Okay. You don't watch too much financial TV. True story. I'm embarrassed to say I had Kevin, when he was 8 years old, watch 5 minutes of Kramer.
Oh.
Now, he thought it was a joke. He thought it was like some sort of adult, and back then he was really wild, blowing horns and whistles.
Sure.
And all of that. But he couldn't believe that that this was real, that people were taking advice from him. Number 4, don't act silly when something's important.
What's that?
Well, if you think about it, now that stocks are down maybe about 10% or so, I'm starting to see people panic and sell. Now, you try to explain to any 8-year-old why you're going to buy something when the price is high and sell it when the price is low, and they're going to think that is really silly. And you want to do the opposite. But again, money didn't mean anything to him back then. So that's a whole lot easier. Number 5, know the odds of a game before you play. And, your odds of beating the stock market over any one year aren't horrible, but over longer periods of time, 20, 30, 40 years, are less than 1%. So don't play a game that you're virtually guaranteed to lose. Number 6 was something that I failed to get across to Kevin, and for the most part, he was right. There could be a better way. Owning some asset classes that have lower correlations that might zig when the market zags could add some value, but it also has to be low cost sorts of things. It's very easy to find asset classes with negative correlations, but they also have negative expected returns. So real estate investment trusts, precious metals and mining stock funds had lower correlations, but I couldn't talk Kevin into it, and lo and behold, he's been right, quite frankly. Number
7, I love. This is fantastic, the way you phrased it. Go ahead.
Well, let me go to number. Yeah. Oh, okay. Yeah.
on
Yeah,
bonds.
I'm sorry, bonds. Yeah. Don't lend money to someone who can't pay you back. There was always
I mean,
somebody in this class.
honestly, Alan, that goes for annuities as well. Claims paying ability of the carrier, claims paying ability of who you're lending the money to, in this case, a bond. So if someone's hitting you up with this yield that's just incredible, right? I mean, eight or a second grader is saying, can they pay you back, right? I mean, that's just
Yeah.
common sense. Forget the yield, but everybody gets mesmerized by the percentage.
Yeah. You want a high credit quality when you lend money to somebody, when you buy an annuity, when you buy a bond or a bond fund, et cetera. But there's, by the way, a second trick. For instance, I'll have clients that come to me thinking they're making 4 or 5% on muni bonds, and what they're doing is they're buying them at a premium,
Yes.
and most of the payment is just return of their own principal. And it's the same thing is true on a single premium immediate annuity that
Correct.
pays
Correct.
5%. It's not like a CD that's paying 5%. A lot of
Correct.
that return is your own principal.
I always tell
But
people there's other sites that try to compete with me, Ellen, but they can't. And they'll put up like 5% payout rate or 6% payout rate. I'm like, that is so fraudulent because annuity payments for lifetime income is a combination of return of principal plus interest. And the value proposition is the annuity company will pay forever, like Social Security. But I digress. By the way, number 8's good too. And you got to explain number 8.
Number 8 is, it's okay to lend money to somebody if the teacher guarantees you're going to get the money back.
The teacher. Who's the teacher, Alan?
In this case, well, it was the teacher in this class, but for us adults, it's money that's backed, let's say, at a bank or credit union at the FDIC or NCUA.
Got it.
That now is not the greatest time for CDs versus bond funds, but
sure,
for a long, long time, you could earn more than bonds, and no default risk as long as you kept below those FDIC or NCUA maximums.
Number 9.
Don't bet your lunch money. I offered Kevin a bet. He took his, I forgot what it was, maybe a dollar back then for his lunch. And I said, I'll make you a bet. We'll flip a coin. If you win, we'll give you $3. If you lose, you give me back that dollar. But then Kevin said, but then I won't get lunch today. I said, yep, that's right. He didn't take that bet. But a lot of us adults, we've won the game. We have enough money to
preach it. Preach that loudly. Yes, go.
Yeah, as William Bernstein put it, when you've won the game, quit playing. Doesn't mean get out of stocks completely.
Just quit playing.
But if you have enough money, to support the lifestyle that you need, you don't want an aggressive, risky portfolio. You want a fairly conservative portfolio. I've won the game. My portfolio is 45% stocks, 55% fixed income. And the fixed income, by the way, is a combination of CDs and bond funds.
I tell people, don't chase yield. If you don't have to chase yield, don't chase it. But everyone, they'll put their money at risk for 200 basis points, English 2%, for no reason. They don't need to do that.
Or I'll see people do it for 50 bips, 0.5%, take a ton of risk and lose their principal.
Number 10.
Your fixed income should be the most boring part of your entire portfolio. It's the dullest of the dull.
By the way, that in my world, that's MIGAs. That's just a fixed rate annuity. So it is what it is. Number 10, I love this. Okay. Why do investors love to pay taxes? ? Answer that one.
Yeah. Well, I've always said investing is simple. I never said taxes were. And by the way, that's the majority of what I do in the planning part is all on the tax side. But we do all sorts of things to increase our taxes, buy active funds that trade. Mm-hmm. And that we locate assets in the wrong place. For instance, I mentioned my portfolio was 45% stocks, 55% fixed income.
Right.
If you look just at my IRA and 401k, the traditionals, not the Roth, you'll see I'm 100% in fixed income. If you look just at my taxable account, you'll see I'm very aggressive in stocks. And that's because if you think about it, if you own the stock funds in the IRA, then you're converting what would have been a long-term capital gain into ordinary income, because when you pull it out to live on, that's ordinary income. So no, I'm not saying that that Kevin understands the tax code. I don't think anyone understands the
No, even
tax code.
even the people that write it don't know it.
Yeah.
So,
Yeah.
all right, number 11.
Nightmare Off Wall Street. There are lots of products out there. And these are, as an example, not what you sell, or I'm sorry, what you have on your site, but these are the, incredibly complex annuities with
The
20-year
RILAs, the
surrender.
buffer annuities. Yeah, all that stuff's messy.
Yeah.
Messy.
Yeah. And I tell people, here's, if somebody hands you, I want you to buy this, and it's 2 inches thick, don't bother reading it. Just don't buy it, because I promise that the attorneys and the actuaries didn't write it to protect the purchaser.
No doubt. And I do, you have the second grader look. I always tell people, if you can't explain it to a 9-year-old, don't buy it. No offense to 9-year-olds. I mean, that's what I tell people. If you can't walk up to a 9-year-old and them understand conceptually what you're buying, don't buy it.
Yeah, I would say if you can't explain the whole strategy, you're doing something wrong.
No, I agree. All right, number 12.
Number 12 is pick the low-hanging fruit. I see lots of people that have cash earning 0.01%. At least earn 0.5%. I've still got a savings account at 1%. If you want to earn, 2.5 to 4% risk-free, then take that cash and pay down your mortgage with it. You're not doing something like, I don't want to put more money in your house. I'm not suggesting you do an addition to your house. I'm suggesting you finance it differently. So there are lots of things that can increase return while actually decreasing risk, and that's low-hanging fruit. And we've got to fight the inertia to get that stuff done.
Last
and
one
then
is
finally, number 13
is that the band? Is that the band that I saw in concert as a young teenager?
No, that's a little different. KISS.
Oh,
Keep it simple, stupid. And no, I'm not calling you or my clients stupid, but I love that phrase.
Yeah.
And by the way, the more complex we build something, the lower returns are likely to be. And by the way, that KISS principle works in most things in life.
And
taxes would be the one exception.
I agree. And in low interest rate worlds that me and you have seen cycles of during our life out here in the financial world, that in low interest rate worlds, that's when firms start creating complex structured products that no one can understand.
Well, they're always out there. But again, I think I mentioned that you could earn 12% back in 1981. But think about it. You invest $100,000, you get $12,000 in interest. A third of it went to taxes. You're left with $8,000 or 8%. And inflation was at 14% then. You lost 6% of your spending power.
There you go.
As bad as rates are now, they were worse back then, even though it felt so much better back then.
Allan, we're about up on the edge of time, but I want to close it out. But I want to remind people, and once again, we're going to have all of Allan's stuff on our site. And who you've been listening to is one of the smartest guys in the country when it comes to finances and financial planning. His name's Allan Roth, and he is a master, in my opinion, of the simplicity of financial planning. He's written a book called How a Second Grader Beats Wall Street. You can go to his site at daretobedull.com and look at all of his stuff. And if you do one thing today, is go to his site and sign up for his newsletter. It's literally gold, and you should be reading it. And I would encourage you to engage and speak with Allan and see if you want to hire him to put together a legitimate financial plan under his 8 very simple words of minimizing expenses and emotion and maximizing diversification and discipline. I think that's tattoo material, in my opinion. So with that being said, Allan, and this is your mic drop moment, any parting words for the thousands and thousands of listeners out there and viewers of the Fun with Annuities podcast?
I think you summarized it beautifully for me. Again, stick to those 8 words. Look at your own portfolio, see whether you're meeting those 8 words or not, and then make changes if you're not.
Ladies and gentlemen, that is Allan Roth of Wealth Logic. Smart guy in the room for sure, and so glad he joined us today, and hopefully he'll come back on the #1 annuity podcast on the planet. It just happens to be called Fun with Annuities. I'm your host, Stan the Annuity Man, and I will see you next week. week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.